Hi, I'm Eric.
And I'm Dick. We are the Annuity guys.
Dick, what happens to annuities when markets are just roaring and soaring and taking off?
Well, there's been a lot of changes recently with annuities, Eric, and some of the rates have been affected, because of the treasuries dropping and that type of thing.
Yeah.
But there's still some very good guarantees out there, and the question really is, are they really still viable? When the markets are soaring.
Well, and when people are excited, you're enthusiastic, your money's growing.
The market can do no wrong.
And that's the tough time to even think about, is it time to reallocate and do some things differently?
Right.
But we've all been taught, buy low, sell high. Well, if we're at all-time highs in the markets, maybe this is some time to take some of those winnings, so to speak, off the table and put them in a safe position.
Well, and that's, like you said, that's the hard thing for all folks to do, and that is to say, well, if the market's at a high, because no, the market's just getting rolling.
It's going to go higher.
So that's where, in a traditional correction, the last people to get in are all the folks that, the retail customers that believe, the market can't do anything but go up.
Right.
And so whether we're at that point or not, I think that annuities really are always a viable option if they're used correctly.
Right. Correctly positioned is one of the key components here. I do like the idea of taking pieces when they're at all-time highs and move them into a safe position. We talked about indexed annuities, and what's better than an indexed annuity? Should the market continue to perform, you still get to participate in the upside.
Right.
But if the market corrects, what's better than not having to go through the correction and actually preserving,
not losing your
Yeah.
principal? And again, an indexed annuity, which we've said many times, fixed indexed annuity, gets some of that market upside.
Right, you're not going to get it all.
No, it's a nice way to earn extra interest.
Right.
And as compared to a variable annuity, which does still participate in the market. So you're really not getting your money out of the market with a variable annuity like you are with the fixed indexed annuity.
Right, and that's where we always say with the variable annuity, in order to have some of those features, you're going to need some sort of rider typically, something that will protect your income-based account. It's not your real cash account necessarily, but your money towards future income.
Yes.
And you can do that usually even more effectively through fixed or fixed indexed annuities, where you have typically in today's environment better guarantees towards future income than you're getting with variable annuities.
And your principal is always protected because it's not truly invested in the market with the fixed indexed annuity.
Right.
One of the questions, Eric, that really comes up, and it's always a popular subject, and there's no exact answer, and that is, well, how much should I put towards annuities? How much of my portfolio should go into annuities? So give them an answer, Eric.
Well, it depends, of course. It's really an individual circumstance.
Yes.
And what I like to do, and what we've done, is a lot of outcome-based planning, where we like to work backwards to figure out what that income need is and use those annuities to solve for that foundational income.
Which really equates to the least amount to put into annuities. Whether it's like you said, for the income need, or a lot of folks have a risk aversion.
Yeah, maybe they don't want to lose money.
They just don't want to lose money. So it's like, well, how much can you afford to lose? How much are you willing to risk? And then that, some portion of it becomes that baseline, either for income or safe money that folks don't want to lose.
Right. Nothing better than having a pile of cash in front of you and think, all right, I can live off of this. Well, what happens if people start taking chunks out of your pile? Well, that's what happens occasionally when the market corrects.
Yes.
Somebody else is spending down your assets, and what you're trying to do is preserve them. So sometimes not having any change is better than somebody else taking the money away that you want to use for future income.
Well, again, it's loss of control. And, some folks look at annuities and say, well, if I put my money in an annuity, I might lose some control. Well, that's true. And when you put your money in the market and the market does what it does, you do lose some control. So there's a trade-off either way you go. And the key is understanding how you want to diversify, for like you say, the safe money from the income, the growth. And annuities, have a nice position in a portfolio, kind of similar to the bond position, only they offer maybe some additional advantages.
Right. We've been looking at this kind of flattening bond yield curve,
Yes.
because of all the manipulations we've had with quantitative easing and all words that we never even knew 20
Easy
years
for
ago.
you to say.
Well, what better way than to kind of avoid some of those turbulations of the bond market
Right.
than by taking that allocation and looking at an annuity as an alternative for that bond allocation? It's more of a safe,
Right.
low volatility
Exactly.
measure, using to smooth out the pathway towards future growth. But what better way is to kind of look at another allocation?
Yes.
Say, or let's move some of these bonds maybe
Right.
into an annuity allocation.
Right. Well, and the annuities, even though they replicate in many ways the function of bonds, they have additional layers of safety built into them. They have some additional protections from retirement risks, such as living too long or
Right.
outliving your money, this type of thing. So Eric, when we really think about the market, the way it's just been soaring, I mean, it's been great. Kind of the longest standing recovery for many, many years, maybe since even the Depression. And I know it has a lot to do with easy money monetary policies.
It's being
right
artificially
now.
manipulated,
Right.
but
Right. So when folks are facing this soaring market, I mean, just would we want to summarize how that annuities really are still viable?
well, I would say it's definitely a viability. Looking at what your goals are and where you want to put the dollars, an annuity is always a viable option.
I agree.